My name is Alex again. I'm going to be hosting today's webinar, which is a nonprofit accounting overview, going over the fundamentals of nonprofit accounting. For those of you who are not familiar with me or Aplos, I work for a company that provides online software for nonprofits and churches, and primarily of those software offerings is fund accounting. So we specialize in fund accounting solutions for the modern nonprofit and church. I'll tell you a little bit more about it at the end, but that's what we do. So that's me. That is a young picture of me. I am the head of the services department here at Aplos. And then our learning objectives for today, the first of which is going to be understand the basic fund accounting principles in practical application. So go through what is fund accounting, what's kind of the nuts and bolts of it, and how does that then manifest for churches and nonprofits. We're going to look at some common chart of accounts structures for churches and nonprofits and understand the customization options. And then lastly, we'll look at specialized nonprofit financial reporting, including generating a Form 990 report. Okay. So for accountants and bookkeepers and anybody that needs to track financial data for a church or a nonprofit, a couple of things that they all have to go through. One is they have to support the unique goals of the organization. So, most churches and nonprofits, they are philanthropic in nature, but each of them kind of differ. There might be common threads that you can tie between certain types of nonprofits, but really every organization is different. You all have different goals or missions or, unique perspectives on how you want to approach your mission. So every one is kind of different. With that in mind, you need to set up a financial system that can kind of help, track those goals to make sure that you're making sound decisions. You're keeping track of all of the money in and out for the organization and each fund. There's a big kind of foundational task there in setting up a chart of accounts. They also need to help figure out which accounting software is going to help them accomplish those accounting needs and reporting goals. They also need to advise bookkeepers and volunteers and all the people that end up having their hands in the mix of tracking that stuff on how to navigate the complexities of fund accounting, and then prepare and review financial reports or the Form 990. Financial reports being for maybe for donors, their annual statements. You might have a board that you need to report to. You might have financial institutions you need to generate reports for. So with all of that in mind, you have to have a financial system that is set up in such a way that it's tracking all of those complexities. It's tracking that fund accounting, so that way you can generate the proper reports for whoever needs to see that stuff. So with all of those tasks in mind, this would be difficult for any organization. It's just a lot to keep up with. But then with the added complexity of fund accounting, it becomes even more complicated, because with fund accounting, you're not only tracking what money is coming in or going out, for each activity or thing within the organization, but you're also tracking ins and outs and how much money you have and how much money you owe and what's the balance of individual little funds within the larger organization. And we're going to look at a lot of examples of this today. So just wanted to kind of point this as an example. So in business accounting, it is relatively linear in scope, because a business is kind of geared towards generating a profit. So you have money coming in that is for sales or services or products. Those expenses are then used to further that, profit generating activity. But with fund accounting, with nonprofits, they're more focused on accountability rather than profitability. So they need to track money coming in and out, but also in and out for each different kind of fund or activity or purpose that the organization is created for. Okay, so fund accounting principles. So like I mentioned a minute ago, fund accounting is focused on transparency or accountability rather than profitability. So in order to do things, you need money. That is common. In a business sense, you do things, either services or sell things that generate revenue in order for you to continue to do that, to make more money. Nonprofits also need to focus on money, but it's not necessarily for the purpose of generating more, so they're not really in the game to just generate as much profit as possible. They are focused on accomplishing something that's some sort of goal or mission or purpose, some sort of fulfillment to there's a purpose behind the money. So when they get money, it could be due to sales and normal kind of business type activities, but a lot of the times it's due to people donating money either through the form of grants or donations, or pledges, that kind of thing. So when you receive that money, you have an obligation to spend that money appropriately, but also be able to account for it in detail. So that way, if someone ever asks, hey, I donated $1,000 to you that I would, wanted to be designated towards this specific thing. Was it used for that? Or do you still have it? And is it earmarked for that? So the whole kind of idea behind fund accounting is transparency. It's accountability rather than just generating profit. So in a fund accounting setup system, it's going to separate all of an organization's accounting by fund, which a couple of points in the future here, we're going to take a look at an example of that. So as a very basic idea here, in general accounting, you again kind of have a not necessarily one fund, but you have a very linear operation to where you don't have to split your accounting or your organization up necessarily to track different balances. You generate money that goes into your assets. You then spend the money. You might borrow money and whatever you need to do. But again, it's pretty linear as far as the focus goes. But when it comes to fund accounting, you might have different ins and outs and purposes for your cash. So you might have money that you generate and spend for your general purposes. You might have things that are designated for a specific purpose by a grant, and so you need to be able to see, what we've received from that grant, spent towards it, and how much we currently still have. Same with other operations, like facility type fund. So it's splitting again the organization up in order to keep track of all of those unique things. A fund accounting system also obeys self or donor designated restrictions. So here's an example. Let's say if you had a checking account and you had $3,000 in there, but then you applied for a grant, and that grant then gave you $5,000. You go to the bank account and you deposit that check for $5,000. So now your bank says $8,000, but really you've got $3,000 for your own kind of unrestricted type purposes, your general fund, and you've got $5,000 that is set aside or specific to this grant that has given you the money. So in your checking account, you have kind of this pie chart here now. So where you've got $8,000 total, but really $3,000 of it is kind of wedged for what you want, and then $5,000 designated for something else. So with that in mind, of tracking restricted funds of money that is yours, but it's kind of allocated to something specific. Recently, the IRS has changed the way that you, GAAP standards have changed the way that you designate these things to where previously it was unrestricted versus temporarily restricted versus permanently restricted. Now they've done away with all of those restriction type things and just called it donor designated or non-donor designated. So donor designated means someone has given you money that is restricted to be used or allocated for a specific purpose as decided by the donating party. So again, that could be a grant, it could be a donor, any external kind of steering of that money is a donor designated type fund. A non-donor designated fund is money that does not have a restriction as far as it relates to donor specified usage or allocation. This could also include self-designated things. So meaning, let's say your board wants you to allocate a certain amount of money aside to do something. That money is being apportioned out of your kind of unrestricted general money, but it's still kind of a self-designated thing. So that would still be regarded as an non-donor designated fund, even though it is designated, if that makes sense. So it's a self-designated. So you're choosing to allocate the money that way. You could equally decide to reallocate the money not that way. So you have kind of full authority over what happens with that designation. So that would, again, kind of still fall into the bucket of non-donor designated money or funds. And there's a guidance, I forget which one it is, and I should have put the reference here, but it described a fund as a self-balancing set of accounts, which I think encapsulates a lot of what's happening here. So in like a business standpoint, you've got assets, liabilities, equity, income, and expense, and that's it. But with a fund, each fund has its own asset, liability, equity, income, and expense. So like that bullet point said, it's a self-balancing set of accounts. It's almost like within your organization, if you had 3 funds, you almost kind of have 3 mini organizations within your larger total, because each one needs to see how much money you have right now, which is an asset, or even receivables or pledges towards that. So those are all assets. You might even have taken out debt or have unearned revenue or something like that for that fund. So there's your liability. You've got income that's generated, expense that's spent, and then all of that results into an overall kind of worth of the fund or an equity balance that is unique for that particular fund. So again, we're going to take a look at some examples of this, but just keep in mind that a fund is a self-balancing set of accounts within your organization. All right, so chart of accounts structures. So we talked about what a fund is. It's a self-balancing set of accounts. It's something that might be donor designated versus self-designated or organization designated. But either way, it's a separate balance or kind of, bucket of money that needs to be tracked for separately. So nonprofits must be able to account for tracking your funds, unique nonprofit financial reports, Form 990 reporting, as well as they always have extra stuff here, which includes things like projects, programs, departments. They might want to track fundraisers or missions trips or ministries, things like that, that they need to be able to run reports for. So that kind of, again, gets you back to having a proper chart of accounts structure to accommodate for all those things. Okay, so funds are created as equity accounts in your chart of accounts. For those of you who have taken an accounting, a nonprofit or a governmental type accounting course a long time ago, this should sound familiar. So when you create a fund, what you're doing is you're allocating your equity out, because everything kind of flows in and out of the equity. So when you have net income, that goes into the equity. When you have the balance sheet, what your possessions are minus what debt you have equals your equity. So if you have, $10,000 for this fund and you don't owe anything on it, then that should mean that your equity then is $10,000 for that fund. So again, self-balancing. Each fund has assets, liabilities all the way through. So when creating this chart of accounts, you're going to create the funds as equity accounts. Your asset and liability accounts should be indicative of real balances. And what I mean by this is you typically don't have assets and liabilities created in surplus or in deficit of what you actually have as a possession in your assets or owe as a liability. So examples of assets would be your bank accounts. So have an asset account created to track checking, one for savings. You might also have an accounts or invoices or pledges receivable that you need to track. So that could be another asset there. You might also have inventory or land or fixed assets or prepaid items. All of those are actual balances that you either have yourself or are kind of constructively yours, like a prepaid something. So those are assets. Liabilities are money that you owe, real balances that you owe someone else. So that could be accounts payable. It could be a credit card balance that you're accruing. It could be a mortgage that you have out on your property or some sort of fixed asset there. It could be a loan for a vehicle. It could be long-term payables. It could also be unearned revenue. It could be things like, if someone has given you money in payment of something that you haven't performed yet, then that would be a liability. You technically owe them that money back out until you've earned it. So some sort of unearned thing like that. But again, indicative of real balances, that's actual money that you have that is then owed out to someone else. Income and expenses are descriptive of activity. So if assets and liabilities represent real things, income and expenses are more describing how your organization is operating and how you want the money to kind of result on a report. It's not necessarily proper, but technically you could get away with having one income account and one expense account. Again, I don't recommend it, and you're going to want more detail there. But if you just said, "Hey, we made $100,000 and we spent $50," then you have a net income of $50,000. Great, but no one wants to see that. They always want to see more detail for a number of reasons. First of all, how did you get that $100,000 and what did you spend your money on? So income and expenses are descriptive of activity. So when we help people design a chart of accounts, we always say create these things to be descriptive of what you actually do. If you don't pay fees and permits, if you don't have any fees or permits that you pay for, then don't create an expense account for it. You don't need it. It's just going to sit there in your accounts and never be used. So however you receive money, you're going to want to create an income account for that. And again, this is with the result of kind of getting onto your income statement. So if you want to see your income split, to show how much you've received, from individuals versus businesses, you can totally create 2 accounts there and use each one when it applies. If you don't necessarily want or care to see that kind of division, then you could just have contributions income, and everyone that donates comes in through that one line item. So a couple of examples for income: contributions income, grant income, designated donations. Maybe I want to see that split out from non-designated donations, pledge income, and sales revenue. Expenses are typically the most numerous of your chart of accounts, but a couple of examples here: salary expense, rent or mortgage, office supplies, and fees and permits. And then in the example here, I've also got a couple of funds here. So I've got a general fund, a missions fund, building, and special projects fund. So when creating a chart of accounts, again, assets and liabilities, create accounts that represent the real balances that you have or owe. Income and expenses are descriptive of activity. And then your funds are kind of where everything needs to result. And I usually tell people, if you need to look at your bank account and say that out of the money in my bank account, I want to know how much is set aside for this, that, and the other thing, that's probably a pretty good test as to what needs to be a fund. Okay. So in a normal business type chart of accounts, here's what your kind of balance sheet and income statement, trial balance type thing would look like. You've got assets of 10,000. You've got liabilities of 3, which means you have equity of 7. Assets equal liabilities plus equity, or more to me easily described, assets minus liabilities equals equity. So there's that. And then you've got income and expense leading up to your net, which rolls back up to your equity. In a nonprofit chart of accounts, it actually has a little bit more detail here. So like we said a little bit earlier, funds add dimension, meaning you can see more than just the total broad stroke of we have 10,000 and we made $1,000 of net income. What a nonprofit chart of accounts or nonprofit reports would do is allow you to see it in more detail like this, to where an example of a report would be on the very right-hand side, you've got a total. So that's, again, the numbers from a second ago. But that's actually made up of different fund activity. So in my assets, I might have 10, but 4 of it is for Fund 3 and 3,000 for both Fund 1 and 2. My liabilities, I might owe 3,000, but Fund 3 doesn't have any of that. It's mostly Fund 2 with a little bit of Fund 1. And then my equity, again, is the same calculation. So assets minus liabilities equals equity for each particular fund. So my overall fund balance would be 2,000 for Fund 1, 1,000 for Fund 2, 4,000 for Fund 3. My income, too, I might say that, I've got $5,000 worth of income, but, 80% of that was Fund 1, and then Fund 2 and 3 were a little bit smaller. Same with expenses. Okay, so that's an example of how this would then manifest on a nonprofit chart of accounts and types of reports. So common chart of accounts examples here. So what would we typically set up as a fund? Like I said, if you have a bank account and you want to know how much of that is split across for different things, that might be a good test to start with to see what might be a fund. Some other things here might be a grant that supports a specific program but doesn't cover all of the expenses. I also recommend that if you have a grant, typically if you get a grant and you ever need to report back for any reason, it's probably a good practice to set that grant up as its own fund. So that way you're not commingling funds. You're not worried about, we need to send them a report, but I'm not, I know we didn't spend the money for anything else, but I can't prove it. It's better to just create it as a fund so that way you don't ever have to worry about providing the right report back to them. An endowment with interest. So let's say someone gives you some sort of investment and they say that investment should be perpetually just restricted. But so the principal is restricted, but whatever interest it earns, you can use for whatever you want. That's a common example as well. Maybe a church with a missions fund. So your church, you have a bunch of, tithes and offerings and donations coming in, and you might want to kind of self-allocate, or, maybe your elder board or, decision-making team has said that we're going to kind of self-allocate 15% of all money received to be a missions fund. So out of the missions, or out of all the money that comes in, you're dedicating 15% of that each month or annually, however you do it, out to a separate kind of bucket of money. And then a church that also operates a preschool and needs to split the payroll expenses would be a good example a different fund to create. So, if you have a church that has a preschool, maybe, it's the same entity, it's the same, EIN. So there's no separate organization that was formed there. It's just another operation that the church is doing. Pretty common from what we've seen. The church wants to see its income and its, like missions fund and building fund and, youth fund and all those things. But then the preschool has its own operations over there to where they're generating revenue based on, attendance and people that are paying to drop their kids off, and they have their own expenses. So that is kind of a separate thing that you might want to remove from everything else. So that would be an example of why the preschool would probably want to be its own fund as well. So tracking your funds correctly is essential for nonprofit reporting. Like I mentioned earlier, when you create any financial system, any QuickBooks, even, any accounting system that you create starts with your chart of accounts. That's the foundation. So you're creating categories that will then be used in transactions, which is building upon that foundation in order to pull reports. That's the eventual goal, is to provide reports that show, how did you receive your money? What did you spend your money on? How much do you have? How much do you owe, and who? All of those things are answers to questions which are generated by reports, which are built from transactions, which are using your chart of accounts. So chart of accounts is essential for proper nonprofit financial reporting. Some of those reports that this then kind of results in is a statement of financial position, otherwise known more commonly as a balance sheet, the statement of activities, again, more commonly known as an income statement. And if you have a financial system that's geared towards fund accounting, you can run both a balance sheet and income statement by fund. You can also see a cash balance by fund, as well as a statement of functional expenses is another one of those kind of commonly advertised reports for nonprofits. The themes of functional expenses breaks the expenses of an organization up into program versus management in general versus fundraising, which is actually the same kind of division as what the 990 reporting does. So we're going to kind of primarily look at 990 reporting because it's kind of very similar to that statement of functional expenses, but having something that kind of breaks it up into those buckets is required as well. So let's take a look at a statement of financial position. So if you have a fund accounting system, and let's say that you've got 3 funds, general, missions, and building, you should be able to get to a balance sheet by fund. Because again, you have created the fund as an equity account, which means that it's now in the equation of assets minus liabilities equals equity. Let's say that you've been recording income and expenses for that fund, which then results in some sort of net, income, which is represented by a cash balance that you have set aside for that fund, which is offset by any debt, which then results in your equity. So again, it's all self-balancing. Think of each fund as its own little mini chart of accounts, which is within the larger total. So in a fund accounting system, we're using an example from Aplos because we're shameless and we want to do it. Here's our 3 funds here: general, missions, and building. If I've been tracking these funds, I would be able to get to this and see, in column, the first kind of middle column here, general fund, I have 26.5 thousand in my checking account, shaded the color of a general fund. So those are, $26.5 thousand that is dedicated to my general fund. I also have 7,200 in savings, 91 and some odd in petty cash, some accounts receivable, a work truck that I've kind of attributed to be in the general fund, and then my assets that are offset by the vehicle loan, which applies to the work truck, and then some payables that I've got as well, leading me to a overall fund balance at the very bottom there of $45,561.98. And that is a totally standalone applicable balance sheet for that one particular fund. Move over one column and you've got the same thing for a missions fund. So 3725 in checking, 2400 in savings, 7080 in petty cash, 25 accounts receivable, no debt, leading me up to be a ending fund balance of 13,000 and change, and then same with building fund. So you would be able to run a balance sheet which sums all of this to show what's my total asset, total liability, total equity. But in a fund accounting system, you'll be able to get to a balance sheet by fund just because you've been tracking the funds throughout every single transaction. Here is an example of an income statement. So same again, you would be able to get to these reports by fund. Here's an income statement. So they're in a different order, but the most left one here, building fund, I would be able to see what's my income. So here's all of the money that I've generated for my building fund. At the very bottom, my total income is $11,607. Move over one column to general. My total general fund money that I've generated this year in 2016 is close to $45,000, and then my missions fund is 11.5 or so. My expenses are then offsetting that to where it gives me a net income or loss for each fund. So I've got an income statement by fund very quickly. Something that is common in nonprofit and church fund accounting income statements is kind of a reconciliation then to your beginning and ending fund balances. So what happens if you have principal payments? So you've got maybe a mortgage, right, or a vehicle loan like we took a look at earlier. And let's say I'm paying the principal on that vehicle loan out of my general fund. Well, it's not an expense because I'm repaying debt. So where does that show up? How can I see that activity on my reports? Well, in Aplos and in a lot of fund accounting systems, they have a summary type thing here where it shows at the beginning of the period, and in this case, it was January 1st, 2016, my beginning fund balance for all of my funds was at the top line here. So $4,800 in building fund, $17,780 in general, and $4,800 in missions. And then you have your other fund balance movements. So this is going to include anything that impacted the fund balance that was not income or expense related. So this would apply to principal payments. This could be maybe accounts receivable or payable that was counted towards a prior period, but received in this period, something like that. So those other fund balance movements are going to show as a positive or negative line there, which then coupled with your net income or loss for that fund leads you to your ending fund balance as of the end of the year. So those amounts there, 97.80, 45.5, and then 12 or 13,230 would then correlate with my balance sheet to be the overall fund balance equity amounts for those particular funds. So here are some common pitfalls when not using a fund accounting system. So this includes any type of business-related software that is not geared towards fund accounting. There are certain workarounds that people will do to kind of make up for the lack of the fund accounting, but they end up kind of creating more confusion here. So let's go with the same example and say I have a general, missions, and building checking account, or missions, general, and building fund. If I don't have a fund accounting software, it means that I need to somehow figure out a way to separate the money here. So even though I only have one bank account, if I go to my Wells Fargo account, I've got one checking, but maybe I need to be able to see that within that checking, I have separated money out for different things. So a workaround for that would be in your chart of accounts to create a sub-account structure to then kind of move things into the right balance. So instead of, again, having 10,000 in my checking account, I've got 4,000 in a sub account that's general checking, 3,000 in a sub account that's missions checking, and 3,000 in a sub account that is building checking. So you're kind of separating the money into different asset accounts within your chart of accounts. The problem with this is it creates more asset accounts than are actually needed. So you only have one checking account, but now you've created 4 different accounts, one a parent, and then 3 sub-accounts to hold the balances. It also requires you to repeat this process for any of these assets that need another split. So if savings also has general missions and building money, you're going to have to do the same substructure to the savings in order to accommodate the balance of general versus missions in each one of those bank accounts. Let's see, that's an example there too. So there's that. So instead of, again, checking would normally show 19,500, again, we've got sub accounts split out to track those 4 fund balances within checking, same with savings. So if you do that for every single one, you would need to then manually run a report that then exports the data and do some manual summing to say, okay, all of my general fund balances within all of these cash accounts or assets, I need to manually add together in order to get to my general fund being 12,000. So my general fund would be 12,000, which is the sub account for checking paired with my sub account for savings, so on and so forth. It is pretty tedious, and again, kind of a workaround. Another downside to that is it also doesn't track other assets. So again, you'd have to kind of rinse and repeat the process for all of the assets. It also doesn't track liabilities either. So if you have accounts payable, but maybe that accounts payable was generated from maybe you owe contractors when you're doing a building expansion. So you want to track that all to the building fund, but it's just a generic, accounts payable account. There's no fund designation there to say that, I owe this money, but it's really all kind of being counted against the building fund. So really it has nothing to do with my general fund. There would be no way to get to that information without, again, setting up a huge structure and running some custom reports in Excel and combining some numbers. Another pitfall here is paired with that. We often see people that will use some sort of other software feature to track funds in lieu of fund accounting. In QuickBooks, these are called classes. In Aplos, we have them. They're called tags. What they are is they're just extra parameters that you can put onto a transaction in order to filter by it on a report. So I don't have an example of it, but let's say that you create missions, building, and general as classes in QuickBooks. So as activity comes in, you're tracking, we got this much money, we spent this much money, and I've tagged it or classed, applied a class on all of it. So now I can run an income statement by class, which shows me I, had this much income, this much expense, so this much net for this particular class. And that's fine. I mean, that'll get you to activity within the period that you're looking at. But back to our previous example here, what it's not showing you is what was your beginning fund balance, which again is a sum of your fund balance across all of your assets and all of your liabilities. How much money did you have attributed to that fund in the first place? And then what were your other fund balance movements? So classes and tags and Aplos don't apply to anything that is not income or expense. So if you paid principal, that wouldn't necessarily show there. So you're missing that. You've got the net income, but then you also don't have the ending fund balance. So just because I had, $100,000 worth of, net income for a particular fund, I might have also been paying off a lot of things that didn't make it onto that report, or I might have started with a deficit in that fund. So that doesn't mean that I have $100,000 to do whatever I want within that fund. There's a lot of other information that's missing there. So that's another common pitfall that we see with a non-fund accounting system. So a balance sheet with funds in something like QuickBooks would look like this, to where you'd have checking and savings and accounts receivable, credit card and accounts payable in the liability section. You've created multiple sub-accounts to kind of track the separate balances there. So you can get to what is my total assets, total liabilities, and then the equity you can even get to, you can set up, 2 different equity accounts to be donor designated or non-donor designated funds. But again, to get to that equity balance, you would have to first go back and sum all of the assets, offset them by their proper liabilities, factor in the net income by the class, which also doesn't include any non-income or expense items. So you have to manually get to all of those numbers and then post a manual journal entry adjustment in order to move money from one equity account to the other. So if all of that is making you go a little cross-eyed, that's the purpose. Is a non-fund accounting system just does not. It's fundamentally different. So not to pick on QuickBooks, it's just they're kind of synonymous with accounting software. And a good example, we have a lot of customers that come from QuickBooks, which they are fantastic, unrivaled in the terms of business accounting software. Very great platform. But for churches and nonprofits, even government institutions, anybody that needs to do the fund accounting, it falls short, along with most other financial systems out there. So nonprofit specific requirements. So in addition to everything we've just talked about, let's say you have a fund accounting system, you've got your chart of accounts set up to track those funds, you've got some tags or extra things to track fundraisers and departments and all that kind of stuff. You've been entering transactions. You're able to pull the reports by fund that you need. What else? What are some other nonprofit specific things that you need to kind of check the box for in addition to all of that? Well, one is a Form 990 submission, and the second is being able to track donor statements and issue contribution statements at the end of the year or periodically, however often you want to do it. So with Form 990, there are a couple different forms here. So the first one is the Form 990N, and this applies to any nonprofit that has under $50,000 of gross receipts. So total income, 50 grand or less, you need to file what's called the Form 990N. And it's due on the 15th day of the 5th month of your fiscal year. A lot of little sounds there. 15th of the 5th month of your fiscal year. So for most people, if it's a January fiscal year, that means May 15th is your deadline. And if you have a 990N that you need to file, really all it is, it's a completely electronic form. We allow you to file it, so you can use Aplos to file that form. But really all it is who are you? What's your EIN? Did you make less than 50 grand? Did you go out of business? What's your address? And is all of this information still correct? And so the form takes, 5 minutes max, and then you send it off and you're done. When you get over $50,000 of gross receipts, you go into a bucket that is going to file the Form 990EZ. And that applies to any nonprofit that has between $50,000 and $200,000 of gross receipts and or under $500,000 worth of assets. So if you had, somewhere in the range of 50 to 200 gross receipts, but you have $1 million worth of assets, it's going to push you over the limit, or vice versa. Less assets but more revenue pushes you over into the full Form 990, which is the form that people need to file if you have over 200 grand in receipts and or over 500 grand in assets. Again, Aplos can file the 990N and the 990EZ. So if you need to file those two, we can provide that service for you. We've built kind of a wizard walkthrough that goes through the EZ. We do not have one for the full Form 990, but either way, the 990EZ and primarily the full Form 990 makes you categorize your expenses into those buckets that we mentioned previously, which are similar to the statement of functional expenses, which are management in general, program, and fundraising. So in a financial software that accommodates for fund accounting, make sure that they have some sort of feature there that can allow you to track those 990 divisions as well. And then also keep in mind that some entities, such as religious institutions, are exempt from filing the 990 report. So like I said, categorized expenses, the 990 full form specifically makes you bucket your expenses into program and service versus management in general versus fundraising. In Aplos, we actually have a feature where you map your chart of accounts, whatever chart of accounts you want. So you've developed your own chart of accounts. You then take it and you map it and say that, these accounts apply to this particular 990 category. And these accounts map to this 990 category. So what it's doing is it's basically creating a conversion for you. So that way you don't have to operate your personal and ongoing year-to-date financial statements in 990 terms, because those will typically not be for the average user. Those are, if anyone's ever read through, an IRS form, that's what it sounds like. So a lot of fun there. But when you map it and when you convert it like that, it allows you to kind of track your financials however you want and however your board prefers, but also be able to run the correct reports for the 990 form. And then for contribution statements, last thing here is, in addition to fund accounting, you want to track income, expense, assets, liabilities, and fund balances. But along with that is the money that people have given to you. And so if you are an organization that needs to provide giving statements for money received from people, you're going to need some sort of feature that can help you track contribution statements. So being able to track accurate donation and pledge tracking. The software will also want to track donor restrictions for temporary, or that should say donor designated funds. But if someone's giving you money for whatever you want, you can use it however you see fit. That is a donor donation that they will then get credit for, but it's unrestricted. It's non-donor designated, so you can put that into your general fund. Or if they've said, here's $1,000 for the carpet in the chapel, then there you go. That's another kind of donor restriction that you need to keep track of. And then a separation of tax deductible donations from other income. So if Alex donates 100, but then he also, goes to an event where the tickets are 25 and he gives you 50, well, 25 of that is considered non-tax deductible. It was in kind of a pseudo payment to attend to the event. So there is also a need to be able to track tax deductible versus non-tax deductible donations for each of those donors. So, with all of that in mind, in an ideal financial system for a nonprofit, you've got some sort of combination of all of these kind of interrelating to each other. It might start with fund accounting, but then that also gets you to, our donors donate to us, and so we need to give them the idea or the ability to donate more. So there's some sort of portal that they can access and donate to you, which then leads to online donations, which might interrelate with some sort of event management, which might also have need of tracking that event in detail and seeing, who gave and how much, and who is a donor that we can ask for more from, who's a donor that has not donated this year but did donate last year, some sort of, contact or relationship management type software, which might also relate to managing your grants that you've received and scholarships, all relating back to how that impacts your financials, which is fund accounting. So you can see that all of this kind of interrelates. So having a financial system that works for nonprofits is key. So finding something that can provide all of those would be beneficial. Enter us. So we are working on kind of completing that circle. We, again, kind of primarily focus in the fund accounting realm. We also do some CRM, some donor management, that kind of thing, and e-filing. And later we will be building out other tools as well to become that full circle encompassing software solution for nonprofits and churches. So that's a little bit about us. And if you have questions about Aplos, we'd be happy to talk to you more. But for now, let's do a little bit of a recap. Today we took a look at some learning objectives. We took a look at a basic understanding of fund accounting principles and practical application. We then looked at some common chart of accounts structures and examples for nonprofits and churches and understood customization options. And then lastly, we took a look at specialized nonprofit reporting, which included, balance sheet and income statements by fund, as well as generating a Form 990 report.